Hello, you're watching Dukascopy TV and welcome to the week ahead with me, Ben Jones. On the line today we have Roger Josefsson from Danske Bank. Roger, thank you for joining me. Beginning with a look at Tuesday, we have New Zealand releasing their unemployment rates for the past quarter. Now, bearing in mind Moody's have recently considered downgrading the country's AAA rating, what are you expecting from this?
When you look at developments in the vicinity of New Zealand, you can clearly see that there's been a bit of a weak period. But now, especially since China is heating up again, we do expect the consensus expectations of an employment change of 1.5% or in excess of 1.5% to materialize actually on a year-on-year basis. So we can't really see these numbers disappoint now that everything in the surrounding area seems to be strengthening again, and the retail sales number has also been quite okay in the last couple of months. If you take away the last card spending numbers, that was down a bit, but on trend it seems that the New Zealand economy, I believe, is improving again.
Okay, now moving on to Thursday, we have the Bank of England rate decision, quickly followed by the rate decision from the ECB. Which of these events are we seeing greater market speculation around?
Well, I think now that we've had a couple of talks especially from Novotny from ECB, was out the other day and said that he was inclined to believe that there would be a new LTRO operation once or before the last one is due, and I think that is basically to be expected. We still see that the peripheral banks in the periphery, European periphery, are having quite large difficulties in financing themselves. So I think that's a done deal. However, we are a bit concerned about there are some market participants. There are not many analysts, but there are some market participants expecting them to lower rates. We're not that sure that will come about, or rather, that's probably premature, especially now that we can see that the euro is coming back from the very high levels that we saw over the last couple of months, basically.
And on the final day of the trading week, we have the US data release outlining the change in non-farm payrolls for the past month. With this release being delayed 7 days by the government shutdown, are we still seeing shockwaves in the data? And overall, how do you see this event affecting the market?
We've basically pushed down expectations quite a lot. I think they're about 125K right now, and that's probably a bit low, I would guess. Especially, I think there will be focus on the private side, since we don't know exactly what happened with related or government-related activities. So I think, as we saw with ISM, maybe it won't be the other day. Maybe this won't be all that bad number. And the thing is that from a Fed perspective, I don't think that this number per se will be that important, because as Federal Reserve and as most analysts are saying, the numbers over the coming couple of months will be very distorted by the shutdown. So I don't think there will be much of a reaction from Fed from these numbers. However, if we get some special disappointment from this number, then there might be quite large market reactions, but just briefly until the Fed sets the agenda straight again and says that it won't be until the beginning of next year that we will see more stable numbers out of the US economy.
It certainly looks like an interesting few days coming up, Roger. Thank you for joining us today. Now, that is all for the week ahead. Make sure you stay tuned throughout the week for interviews and updates on these events. But for now, goodbye.